Good afternoon. Welcome to the National Institute of Economic and Social Research. Delighted that you've been able to join us today for this event on fiscal frameworks. We're very pleased to be able to launch a debate that we want to have this year on what our fiscal framework should be. Want me to think about the awful events that we've all been through in the last year or so in the middle of this COVID pandemic, and to be clear, it's not over. We very much subscribe to the view it's not over for anyone till it's over for everyone. And we can see devastating pictures from other parts of the world as they confront this ongoing pandemic. And at the centre of our own government's response to the pandemic has been accommodative monetary policy stance, on which the Institute has done much work on, but also the correct use of fiscal policy as a way of insulating to a degree the impact of lockdowns, shutdowns, endogenous social distancing, and the impact on people's lives from this pandemic. In the middle of all of that, I think what we need to do is we possibly emerge from the impact of the pandemic on the broader economy and on society, is think very seriously about what appropriate fiscal framework we need. We'll recall that the fiscal framework has been evolving over a couple of decades with the introduction of new Labour's fiscal rules in the late 1990s and a formal fiscal framework in 2010 with the establishment of the Office for Budget Responsibility. And indeed, we argue in our report, Designing a New Fiscal Framework, Understanding Confronting Uncertainty, that many elements of our fiscal framework are good and need to be maintained. And indeed, commentators around the world, global commentators, have complemented elements of the fiscal framework. The OECD's external report on the fiscal framework is very helpful in sorting out what works and what doesn't. And so I'm very glad that the Nuffield Foundation was able to support our wish to undertake some serious examination of the fiscal framework and think for ourselves as to where we want to land as we come out of this COVID crisis. What is the role of government debt management, instruments that are issued? What is the role of appropriate communication? Where does the budget or set of decisions around a budget sit within the management of the economy and economic policy in general? These are the issues which we grappled, and I'm delighted to have had the time over the last couple of years to think about these things with my colleagues at NIESR, but also with many of the colleagues who've contributed to this report, but also some who've joined us for today. Because, as I said a few moments ago, this is the year where we really have to address the fiscal framework. The budget last month said we're going to have a new fiscal framework in the autumn of this year. It's invited commentary alongside that. This is, I would argue, the first serious attempt to provide commentary on what the fiscal framework should look at. The OBR will be looking at its own biennial report on fiscal risks over the summer, where it's going to assess the risks from coronavirus, aging, climate change, talk about what risks there may be to fiscal policy. And so in the middle of that question about where and what is the role for fiscal policy, I think it's the obligation of the National Institute, which has done so much work thinking about fiscal policy since its inception in 1938, to be part of this. So I want to invite you all to enjoy the seminar that we're about to listen to. Do feel free, and this is a first for me, to make Twitter comments using the hashtag fiscal frameworks. I hope I got that right. Someone will tell me if I've got it wrong. We can also take questions through the Q&A function, so send that to me. But what we also would love for you to get in touch with the Institute as well and tell us your views about where the fiscal framework needs to be repaired and thought about. Because getting that right is so obviously important. The market economy, as we all know, has got many gaps. It's not a set of complete markets. And therefore we need fiscal policy to think very hard about what it can do and act in a sustained and consistent manner. If I may now, I'd like to introduce or turn to Tim Gardam, who's the director of the Nuffield Foundation, for some words about their locus and their involvement in the National Institute's work over the last couple of years. Tim, I ask you to join.
Well, thank you, Jagjit. Thanks for giving the Nuffield Foundation a moment to explain why we were keen to fund today's report. First to say, I think we're very glad that we did, and how timely it seems. Indeed, understanding and confronting uncertainty was quite a prescient title for you to come up with in 2018, because we're in such a different context now to when we began. And it's good to see the report already getting the attention it deserves. I think at first glance, NIESR's work may seem to be rather different in focus to most of the Foundation's research portfolio. The Nuffield Foundation was established in 1943, just 6 months after the publication of the Beveridge Report, and it had that remit to advance opportunity and social well-being and to drive the evidence of independent research into policy making and practice. And in the admirably direct language of the time, our mission was, and is still resonant today, the advancement of health and the prevention and relief of sickness, the advancement of social well-being by scientific research, and the improvement of technical and commercial education, including the training of teachers, the care and comfort of the aged poor, the relief of the disabled, and the relief of children suffering from mental or other handicap. Well, the Beveridge-Nuffield link extended into the Foundation's early years. In the 1950s, we gave Beveridge recurrent grants to allow him to finish his great work on the history of prices and wages after the Rockefeller Foundation refused him. And the funding stopped only with Beveridge's death in 1963. Today, Nuffield is structured around 3 domains of education, justice, and welfare. And more explicitly, in considering the future social contract in the aftermath of COVID, much of our work now focuses on the foundations and pathways of a just and inclusive society and the restrictions to achieving it. And in the past year, we've funded a number of projects which have revealed the profound social impacts of the pandemic and identified policy options to help address them. These are focused, among other things, on the lost learning for young people from the early years to those just entering the world of work, the stresses on families, particularly those who are already disadvantaged, the impact of the pandemic on people's mental health, and the disproportionate impact on many ethnic minority communities and those on low incomes. So, in a way, this NIESR report, designing a new fiscal framework, may at first glance seem something of an outlier for us, addressing as it does the complexities of the objectives and rules that govern choices over tax, spending and borrowing. However, it is in fact part of a £1 million commitment we've made in 3 projects researching the effective management of the public finances. It stands alongside 2 other studies still in progress, one by Christopher Hood at Oxford and one by David Richards at Manchester University. And all 3 we see as relevant to our remit because they interrogate the fiscal frameworks which in turn shape the policy outcomes that determine so much of our individual and social well-being. Because it's perhaps inevitable that much of the research Nuffield funds points to the need for government to do more or to spend more. In the past few months, we've seen a debate around the implications of the pandemic being framed in terms of whether this can be this generation's Beveridge moment, whether the relationship between the state and citizens is fundamentally in need of a reset. Now, wherever that debate leads, I think one thing is surely clear, that after a year where we've watched the trajectory in public finances that none of us have seen in our lifetimes, the thing that is clear is that government spending capacity is not unlimited. On the other hand, nor is it beyond influence. And so at the risk of stating the obvious, the right fiscal frameworks matter not for abstract technical reasons, but because they're important for creating a successful economy, better positioned to support and protect the well-being of citizens, something ever more complex in an increasingly diverse and fractious society. And even a strong economy is not in itself sufficient to protect everyone, especially those exposed to the greatest risks and the greatest vulnerabilities. And so fiscal policy has to have a major distributional consequences. As we're seeing in the United States, such considerations lie at the heart of the debate about the nature of any post-COVID social and economic settlement. And so for us, what makes this NIESR report so arresting is the manner in which it brings together the perspectives of rigorous research and those who have weathered the greatest storms in the Treasury in recent history. And in evaluating how successive government expenditure plans have responded to changes in the economy, I think this project has identified guiding principles for public spending that are more salient now than ever. And importantly, the team recommend that fiscal strategy must pay particular attention to the distributional effects on people, including on different regions, and of course, the devolved nations. So this NIESR project does indeed serve the same aim as Nuffield's core agenda, which is ultimately to improve people's well-being through safeguarding our health, education, livelihoods, and public services. And as Chapter 1 here states, crucially, fiscal targets should not be limited to the pursuit of higher growth. They should also include measures of well-being. And this speaks directly to the Foundation's mission and our belief that research and analysis of this quality can provide a vital role in informing the policies and decisions that fundamentally affect all our lives. So I'm much looking forward to today's seminar and to the report's reception. And I'm now going to hand you back to Jagjit.
Well, thank you ever so much, Tim. I always want to say that the Nuffield Foundation has been a long-time supporter of the Institute, and indeed, the Institute was set up under Beveridge's guidance as well, and has a very similar objective outlining it. So we're delighted to be able to combine with you on this very important work. And I can't think of anyone better to turn to who's supported our work at the Institute since her appointment and before, Clare Lombardelli, the Chief Economic Advisor at the Treasury and Director General of Economics and the head of the Government Economic Service. We've had many conversations about trying to understand what's going on in the economy. There's that B word with an X in it. We've had lots of talks about that I won't mention today if I can avoid it. But then also just how we've confronted this COVID shock. And it's been a source of great succor, I think, that coming at things from a different angle, we've often come to similar conclusions on what to do on labour markets and investment and other matters. So Claire, I want to thank you for your support while we've been working on these and wrestling with these problems at NIESR, but also with this report, because there are a number of discussions in the past about what we've been working on. And I'm glad you've also been able to find time in your busy schedule to write a preface for us for it. So if I could just introduce Clare Lombardelli to say some words before we move on to the first panel session. Claire.
Thank you ever so much, Jagjit, and hello everyone. I'm delighted to be here today to introduce this report on fiscal issues, fiscal policy. For those of you who don't know me, as Jagjit said, my name is Clare Lombardelli. I'm the Chief Economist here at HM Treasury and Joint Head of the Government Economic Service. I'm really delighted to be here to introduce this volume today. Fiscal issues have had too little focus from economists over recent decades. In macroeconomics, much more study and commentary has focused on monetary economics, though not least in response to recent events. That focus is now shifting and a much greater discussion of fiscal issues is happening. So it's great to see a report like this making a contribution to our understanding and our consideration of these issues. There's an easy case to make that fiscal issues are some of the most interesting and important in economics. Certainly from a government perspective, they're absolutely critical. Fiscal policy is basically the heart of what any government does, raising the revenue needed to deliver the investment, services and transfer required by citizens. In delivering its fiscal policy, the government is influencing the distributional outcomes across the economy and also critically across time. And it's influencing growth in the near term, and through public investment and incentives, it's also affecting growth in the longer term. This report includes a wide range of papers, theoretical, empirical, and historical. It's a really enjoyable and informative read about fiscal policy and how this worked in the past and how it could work in the future. So the first discussion today is about fiscal rules and fiscal frameworks. As we've heard from Jagjit at the start, the UK's fiscal framework has been in operation for just over 10 years. It's served us well, enabling the delivery of economic objectives within controlled public finances. Its most recent test being the largest economic crisis within living memory. And within the framework, the government was able to take fiscal action at a size and a speed which was unprecedented, delivering policies such as the furlough, as was necessary to support households and businesses through this extraordinary crisis. The UK's framework is well respected and aspects of it have been copied around the world. As the OECD noted in their recent review, the OBR is now a fixed part of the UK's institutional landscape, and it provides independence, greater transparency and credibility to the economic and fiscal forecasts on which the government's policy is based. As we've heard, the government is currently reviewing the fiscal framework, as it's sensible to do from time to time. The current level of uncertainty means that now is not the right time to be setting specific fiscal rules, but providing economic uncertainty recedes further, this will come later in the year. So this first panel today is timely as an opportunity to discuss some of the issues that should be considered as part of this framework review. So let's turn to that.
Thank you very much, Claire. I think I'm just reiterating the book is something we're all very proud of contributing, but what's just as important is that we have this debate as the government moves towards thinking about what its fiscal framework ought to be in order to build upon elements of an excellent start with the framework that was adopted in 2010. So if I may, I'd like to turn to the speakers for our first session. We give them each around 5 minutes to discuss things that they think are relevant in terms of thinking about the fiscal rules and frameworks. And we have, this is in no particular order, but first will be Grice, who is a very well-known public administrator, has worked as an economist in the civil service, but ONS and Treasury, and has someone from whom I've learnt a lot in discussions with him over a number of areas, not only measurement, but also the design of public policy. After that, I'll turn to Dr. Hande Kucuk, who's Deputy Director of the National Institute running macroeconomic policy, and then to Martin Ellison, who's Professor of Economics at the University of Oxford and a Fellow of Nuffield College, Oxford, and then Philip Turner, who is a long-standing senior official at the Bank for International Settlements and is also a professor at the University of Basel. Philip will discuss some elements of the international demand for sterling bonds. And then finally in the session will be Jerry Holtham, who's professor of the regional economy at Cardiff Metropolitan University. So I wonder if I could just ask you in turn to perhaps spend 5 minutes picking up some of the things that you'd wish to talk about, given your direct loci into this report. And then we can move into some questions that we can take between the five of you in the remaining time for the session. Joe.
Well, thank you very much. And we look forward to the discussion as well. I mean, I start off from actually taking the same view, I think, that Clare already mentioned, that fiscal policy has been a bit of the poor relation of UK economic debate for quite a long time. There was a big change in fiscal policy design around about 1997, 98, and some very big and important institutional changes, particularly with the OBR a decade or so later. But otherwise, as compared with the attention which monetary policy and some structural policies get, fiscal policy has been a bit of a poor relation. I also, though, agree with Jagjit that one of the reasons for this is that actually it's quite a strong framework. And having been involved in earlier stages of some of that, I'm sort of quite pleased about that. Nevertheless, I think we've got to the point, even if we hadn't had the COVID emergency and the implications of that, where there's a growing list of topics that could really do with a bit of serious attention in terms of this debate. And just to list those very briefly, the ones that strike me as being important. The one is, we've got a bit of a shuttered view of fiscal policy. We tend to concentrate on net public debt. Actually, the measures that we use, the targets we have, relate to barely half, in fact, somewhat less than half, I think, of the liabilities the public sector has. And they almost entirely leave out of account the asset side of the picture. Now, any kind of sensible approach to fiscal policy, I think, would look at both the assets and the liabilities. How might one do that? And given the advances we've made in the whole of government accounts and related issues, I think is a very pertinent point for the current debate. One thing that goes with that, but actually going, I think, back to what Tim was already talking about, is the prospects of generational accounts of the UK. We've thought about that from time to time, never quite got round to doing it in as thorough and as transparent a way as we might do. But certainly in terms of a debate where generational differences are very important, and COVID has underlined that, then getting some serious measurement about generational impacts of fiscal policy, I think, is one of the important dimensions of distribution that Tim referenced. Another one on the list, I think, is something we never really sorted out at all, and that is the mix between monetary policy and fiscal policy. That was a sort of a big gap in the arrangements in 1997, 98. Given circumstances where the Bank of England has run out of room for at least one of its major policy instruments, that seems to me to be a debate which certainly could do with being looked at quite carefully. But I know other people have things to say about that, so I'll say no more about that. One thing which I think hasn't received much attention is the interaction between fiscal policy and productivity. The OBR, the Treasury tend to look at cyclical effects very carefully, but I think there's an underlying issue and growing evidence of a need to look at whether fiscal policy has a direct bearing on productivity growth, trend productivity growth. We've lived for the last 10, 12, 15 years now with some of the lowest productivity growth the UK has ever experienced. Is that purely a coincidence, or actually does it have something to do with the fiscal policies which have been pursued over that area? think the jury is out on the answer to that question, but it's certainly a question which could do with some attention. In terms of public services, there it seems to me two issues above all could do with further attention. We've been talking for at least 30 years about the importance of looking at outputs as well as outcomes, as well as money spent. But actually, in practice, we've made very little difference, very little progress, I think, in the public debate or to moving towards an output-based approach to public spending. And one area in particular where that seems to me to be important is the lack of articulation between what we spend on the infrastructure and this long-standing problem we've had with infrastructure in the UK and the outputs we get from that money. Now, I was interested to see that some of the Treasury documentation at budget time talks about that, but I'd hope that's very much the kind of issue we might look at in more detail. And just finally, and to underline what I think has already been said, this is an ideal opportunity to have a serious debate about these issues. I hope and I imagine we will have a very nice discussion this afternoon. I doubt if we're going to get to the bottom of any of these. So really, we need to take advantage of the next 6 months or whatever it is until budget time to ensure that we really do have a thorough public debate, honest public debate about some of these issues. Thank you. That's quite enough from me.
Well, wonderful. Thank you very much, Joe. Went through so many things so concisely and accurately. And thank you for that intervention. There's a whole list of things for us to consider. I know some of them will be picked up by other people, particularly the point on productivity. I know Bart in the second session will be coming in some detail on, and certainly distribution issues, and the monetary fiscal mix, I think, is something that Jerry Holtham and others will also wish to discuss, and Martin, I suspect. If I may, I'd like to turn to Hande Kucuk to make her points, perhaps based on the report.
Thanks, Jagjit. Hello, and thanks to all our panelists and participants for joining us today. I'm going to draw on our report and talk about what we see as the main issues regarding the current fiscal framework and introduce some of our views as to how these could be addressed. A recurring theme in the discussion of fiscal frameworks, obviously, is the requirement to find the right balance between the flexibility to respond to changing economic circumstances and the credibility to maintain control of debt. Rule-based policies matter for credibility as they impose both external and internal discipline for fiscal policy, and they ensure that economic agents can condition on government's plans. But fiscal rules have been frequently changed by governments and are sensitive to political rather than economic criteria, often quite sensitive to political rather than economic criteria, and they are tied to parliamentary timetables which do not really coincide with economic cycles, which might undermine their credibility. And strict adherence to self-imposed rules implies that taxes and spending could be adjusted sharply in response to minor changes in forecast assumptions or in the face of small shocks that imply public deficit or debt would break self-imposed limits. And sharp adjustments in taxes and spending in pursuit of arbitrary public debt and deficit targets can lead to adverse effects on the welfare of citizens and communities. Thus, one of the key issues with the current framework is the disconnect between the economic objectives of fiscal policy, the social welfare function, and the concern with public debt as a share of national income. A related problem, we think, is that the headline fiscal position for which targets are set depends heavily on a business cycle that is not fully known or understood in real time. So this creates complexity in understanding the underlying fiscal position or the fiscal policy stance implied by the fiscal rules. Indeed, our research based on analyzing 5 decades of real-time data on official economic forecasts and fiscal policy plans in the UK shows that fiscal outturns deviate significantly from initial plans. And official forecasts tend to overpredict output but underpredict expenditure. And especially forecasts for individual expenditure components such as government investment and current expenditure excluding interest payments, which potentially give us more information about discretionary policy choices, underestimate outturns by a bigger margin in general. Our research also shows that public expenditure plans tend to get revised quite significantly up or down following downward or upward revisions to GDP growth. This is mainly dominated by the effect of automatic stabilizers. And this is because of both surprises in the evolution of demand in the short run and as a result of difficulty of understanding long-term trends that affect potential growth rates. So we think that expenditure obviously is not fixed and more transparency is required as to how expenditure would respond to changes in economic circumstances, which occur very frequently. So given the uncertainty regarding the economic cycles, we think that the fiscal framework should provide more guidance as to how fiscal policy would respond, especially discretionary fiscal policy should respond if certain risks materialized. So we think that the OBR could produce economic forecasts and alternative scenarios as they do, I mean, but more conditioning on or informing government thinking about fundamental fiscal policy choices in different states of the world. So what would be the conditionality in furlough, for example, if a second wave of the pandemic happened or if there were lockdowns? So we think that these could be provided in advance of the risks materializing. And communication about the conditionality in fiscal instruments and the associated paths of deficit and debt would contribute a great deal to demonstrating that fiscal policy implements state contingent measures to smooth the economic cycle. And we think that this would support policy effectiveness by reducing uncertainty and increasing confidence. To summarize, we think that one of the fundamental macroeconomic issues with the current framework is the disconnect between the economic objectives of fiscal policy and arbitrary limits on deficit and debt. Besides, large revisions in spending and revenue plans due to the uncertainty about economic cycles tend to create an additional layer of uncertainty, reducing policy effectiveness. Therefore, a robust fiscal framework should combine clear principles for spending and tax with state contingent adjustments to support the ultimate objectives of fiscal policy with a medium-term perspective. And Adrian will talk more about a wider range of our proposals. Thank you.
Thank you very much, Hande. That's argues for perhaps a lot more discussion of the decisions than in the few days leading up to a budget and the day of the budget. It does require, I think, a much more detailed ongoing narrative between Treasury, Chancellor and the economics community. I sometimes feel that the lighthouse, the light provided by the media sort of falls on it for a very short period alone, and there's not a chance maybe to go into some of the things in more detail. So a more sustained analysis might be what we're moving towards, and I think Adrian will pick up that a little bit later on. Martin, if I may turn to you for your intervention on this question of current fiscal rules and frameworks. Martin Ellison, Professor at Oxford.
Thank you, Jagjit. Very, very pleased to be here as somebody observes the UK economy, and until very recently I was on the Finnish Economic Policy Council. That's the Finland's equivalent to the OBR, and so saw a Nordic perspective on looking at the COVID from the public finances. One thing that's clearly happened is that there's been increased interest in fiscal policy and the way that the Treasury is making decisions. And I'm on the side of Clare and Joe here of about time. We've really been waiting for that there's been so much time spent listening to what the Bank of England is doing, while the Treasury, it's very hard to find that attention. So I think that's very welcome. But I'd like to use my few minutes here to say, well, it's not the fact that we've increased the debt so much that means we should think about fiscal frameworks. It's because fiscal frameworks in themselves are worthy of thinking about. And I'm coming to this conclusion because what's happened in this pandemic is, well, debt is done what it's supposed to do. We take on debt because we've been hit by a terrible negative shock. So just like a firm has inventories to buffer themselves against shocks, the economy, we have national debt that we can buffer ourselves against shocks. So nobody is celebrating the fact that we're in a pandemic and we've lost lots of lives, but the fact that we've been able to borrow at such low rates and in such high amounts is something that we should be very pleased about. We've been able to furlough people, we've been able to actually support businesses, which is the right thing to do. Economics tells us that's what we should be doing. So it's not that debt to GDP is above 100%, therefore we need to somehow change what we're doing on the fiscal side. No, it's we change this from the fiscal side because we think the framework even pre the debt was having problems. So I'm going to give you a fairly optimistic view of the size of the national debt, but arguing first of all that it's done what it's supposed to do, and then going forward what's going to happen to that debt. So first of all, I don't think there's any firm limit to how big the debt can be. Over the centuries, the size of the debt has horrified economists and commentators for year on year, saying this means ruin and bankruptcy, and we've learned to live with the debt. Even now, debt has been much, much higher in the past. So at the end of the Napoleonic Wars, the debt to GDP was about 200%. Same at the end of World War II. So we're only about half the way we were in the past. And if you look at the history of the national debt since 1694, we're a little bit above average. So there's no particular need to be worried about the high level. They might be need to be worried about accelerating, but the high level in itself is not problematic. We've also seen long swings in the national debt, and that's what I'm expecting to see in the future. So it will come down quite steadily. In recent times, we've all become amateur epidemiologists, and we all know about the R number and how important it is to keep the R number low, to keep the number of infections down. Well, we can also think about the national debt having its very own R number, which we should keep low. And the R number for national debt is essentially going to depend on three factors. One is the size of the budget deficit, how much we take on debt. After the Napoleonic Wars, we pretty much repaid the debt by having surpluses. And so that really keeps the R number well below 1 because you are paying back the debt. It's hard to imagine that we're going to enter an era of particularly high surpluses now. So I don't think that's going to make a huge contribution keeping R low. Second factor is growth. And growth has been instrumental throughout our history in keeping R less than 1 and making sure that the debt falls. Growth prospects are not fantastic, but I'm sure there's going to be a steady trickle of growth which will help to raise GDP, and that will bring down the debt to GDP ratio. And then finally, it's going to depend on the real interest rate. And so we know now that interest rates are low, they're actually lower than inflation, so the real interest rate is negative, and that really keeps R less than 1. And so we're going to see a steady fall in the debt to GDP ratio as we have the low interest rates and we have growth. My final reason for optimism is a lot of the debt has been locked in to long-run borrowing. So only 1/3 of the debt actually comes up for repayment in the next 8 years, and half of it is after 2030. So I think the interest rate sensitivity is not that worrying. I think the media seems to think that we're on a floating rate mortgage, and if we have an increase in the interest rates, then we're going to have massive increase in debt repayments. That's not going to be true because quite a lot is on effectively a fixed rate mortgage, and so nothing will happen to that. I'll close out with some things that I might be worried about. People might be worried about inflation. I might have some concerns about inflation. I'm not concerned that there's going to be inflation because of the size of the national debt, and that will cause incentives to have inflation to reflate or inflate away the debt. I think those stories are coming from post-World War II times, where inflation did actually play a pretty large contribution to repaying the national debt. I'm less worried that that's going to happen now, because post-World War II, there was a lot of financial repression. So banks were subject to all sorts of caps on the interest rates that they were able to charge. And then because we were in Bretton Woods, it was not easy for people to get access for higher interest rates abroad. So you were able to repress domestic interest rates, which means that inflation was very effective at reducing the real interest rate and bringing down national debt. I find it hard to believe we would enter into such financial repression in the future. So we might be worried about inflation because Biden is stimulating the US economy too much. We could perhaps talk about that, but I'm not worried about the fact that the size of the national debt creates incentive for inflation. Couple of worries: funding crises. Of course, sitting on an OBR type body, I'm worried about fiscal space, the ability to borrow if the next crisis comes along. Ideally, yes, we try to get a bit more fiscal space, but this is supposed to be a once in a generation crisis. It's the first in my lifetime, and I'm over 50. So it's at least one in a 50-year crisis. Hopefully, I'm not going to get 5 more of these in the remaining of time of my life. I might get 1, maybe 2. If it really is a 1 in 50-year crisis, well, then we have to accept that it's going to take 50 years to bring back down that debt. Last thing I worry about is a little bit of over-eagerness to lock in to the debt too long. So it's true interest rates are low, but what if they fall even lower? If we lock in now, are we losing out on the possibility of even lower interest rates in the future? Now, you might say that's hugely speculative, but over the last 3 centuries, we have seen that type of thing after the financial crisis. So let me just finally say what I guess I really do worry about, and this is particularly happening in Finland. In Finland, you tore up the rule book with the pandemic because you wanted to fund all sorts of health expenditure. There was all sorts of testing. You wanted to do a furlough type scheme. That's fine. But you've got to make sure you don't lose the rule book when the pandemic is over. So yes, we're now coming out of the pandemic in Finland. We're also doing the same in UK. I would say a big risk is that we've got very used to this lax fiscal policy, and we need to make sure we get back to at least the fiscal framework that we had before. Now, that's not at all to criticize what Joe is saying or what Clare is saying or what Hande was saying, that we can improve that framework, but it may be the first order worry just now is that we'll reintroduce fiscal discipline and we don't continue on some rather lax world that we've got used to. I'll finish there and hand back to Jagjit.
Thank you, Martin. Quite excellent survey of the issues. And if you haven't read it, I'd very much recommend not only Martin Ellison's and Andrew Scott's chapter in the volume, but also their recent work looking at the market price of debt and some interesting insights as to what the true value of debt is there as well. That's something Martin's been working on for a number of years. And then now, I'd like to turn to Philip Turner, formerly of the BIS, now at the University of Basel, and also a visitor at the National Institute. Philip.
Jagjit, thank you. Well, I share Martin's optimism. As you know, at the BIS, people used to talk for ages about the economy sinking under the weight of debt. And I said, well, is it sinking under the weight of debt, or is it sinking under the weight of assets? Because what is a liability for some people is an asset for the others. So what Swapan and Pradhan from the BIS did is we looked at UK bonds as an asset for foreign investors. And the striking fact is over the past 20 years, there's been an explosion of global investor demand for bonds denominated in the main currencies, dollar and euro, of course, but also sterling. Now, we've all heard of the global savings glut of Bernanke, strong income growth in Asia, need to prepare for longer retirement and so on. the savings in excess of domestic investment opportunities, serving to drive down interest rates. Now, of course, investors, foreign investors, need to guard against currency risks, and they're constantly moving their portfolios between currencies as circumstances change. And so the major bond markets move very, very closely together. Global demand dominates domestic demand. If you look at even the United States, if you want to understand how dollar markets are moving, you've really got to look at international influences, even for the US market. And because of that, it makes sense to look at a world long-term interest rate, and the calculation that we prepared at the BIS is in our paper. This is based on the yields of government bonds, which provide the benchmark. Now, the world long-term interest rate has been on a 20-year decline that nobody really expected. I mean, 2000, nobody expected the 20-year decline that we've seen. It went from around 5% in the early 2000s to a little over 1% now. So even if investors apparently expect short-term rates to rise, the pandemic will finish, monetary policy will become more normal, they still prefer to hold bonds, even at such a low rate. Now, this trend, decline in the long-term world interest rate, shows that investor demand for government bonds, international bonds, has been much stronger than the willingness of borrowers, of people to borrow at market rates, to issue new debt. So that, in a sense, that observation, in a sense, debunks, at least at first sight, this too much debt story of recent macroeconomic policy. Now, of course, things have changed. There was an exceptional increase of government borrowing in the advanced economies last year, much more to come this year. But what's striking is this has led to only a very small rise in the world rate. The calculation we have it at 1.2% at the end of March. It's almost, if you like, the dog that's not barking. We need to think about that. In any case, it shows that the investor demand for safe assets in the form of government bonds in dollars, euros, and sterling remains very, very strong. Sterling-denominated bonds are about 6% of the total, and that amounted to $5.2 trillion. Now that's about 190% of UK GDP. 20 years ago, in 2000, the equivalent figure was 90% of UK GDP. So the rise in the stock of sterling bond assets globally, and this of course is all issuers, over the past 20 years is equivalent to about 100% of annual UK GDP. And that provides one metric, I stress one metric obviously, for the change in fiscal space in recent years. And it's a metric from the point of view of the investor, from the point of view particularly of the foreign investor. If the UK government were to have a bigger proportionate rise, then the rise in government debt would reduce the share going to other borrowers. What's happened over those 20 years is that UK government debt is up by a little bit less than the aggregate of international bonds. It rose by 90% of UK GDP. So it's not used up all the fiscal space, to repeat by this metric, despite the severity of the COVID shock, but it's used up a lot of it. And significantly more than the United States has. Of course, with Biden, this is likely to change. But before concluding, let me underline two aspects of the UK debt. People have referred to this, that make government bonds especially attractive to foreign investors. The first is the sizable share of the inflation-linked market. There's much more uncertainty now about inflation. Perhaps it's near-term uncertainty, less longer term, but nevertheless, there's great uncertainty. And it's certainly increased the demand for inflation-linked debt. And all indications are that these markets have become much more liquid because of the strong foreign investor demand to have more index-linked paper. And the plain fact is that any asset manager that's managing an international portfolio of inflation-linked debt will have to hold a sizable chunk of UK debt paper. A second aspect that helps the UK is it's the unusually long average remaining maturity of UK debt. It's about 15 years. And it may be it's, with hindsight, it's been too long. It would have been, government borrowing costs would have been much lower if they'd had more short-term debt, but this is another story. What it means is the UK can be pretty aggressive in issuing short-term debt if it wants to prevent a rise in bond yields. So if it faces a crisis for whatever reason, where the yield on UK government bonds seems to rise very strongly because the market gets jittery or whatever, it could stop issuing long-term bonds completely for 1 year. And all that would happen would be the average remaining maturity would go from 15 years to 14 years. Now, the average maturity of US federal debt is 6 years. So it's quite a long way to go. So the UK Debt Office has considerable flexibility to see it through a bond market squall in the years ahead. So to conclude, bottom line is that the financing of the big increase in British government debt that we've seen looks a lot easier from an international perspective than it sometimes does from a domestic perspective. Thank you, Jagjit.
Thank you, Philip. And I think that often is missed in the discussion of debt, which is the supply of debt. And your analysis over a number of years is constantly looking at the demand for debt. I think there's an interesting question there as to the extent we are still the recipients of exorbitant privilege. The lack of development of relatively risk-free assets internationally means that countries like the UK, obviously the US and others, have an advantage in issuing debt. It'll be interesting to see whether that stays in place once debt markets become better developed in the emerging economies. And that's an interesting question as we move ahead in the years. Jerry, if I may turn to Jerry Holtham at Cardiff Metropolitan University, who is very interested in the monetary fiscal interactions and may want to pick up on one of the questions that we've had in the chat, I think from Suzanne Kramer, about are we underestimating the sensitivity of interest payments to changes in interest rates, because in fact, because of QE, a large proportion of our debt is much more short term than we might otherwise have thought about. But you don't have to answer that now, but it's a question that's just come up in the chat. Jerry, please, your intervention.
Okay, thank you very much. Yeah. I've been interested in people's remarks that they think fiscal policy has become the sort of Cinderella arm of macroeconomic policy compared to money, certainly for counter-cyclical policy. And I think that is a relic, or a product anyway, of the high inflation era of the 60s, 70s and early 80s, which led to the dominance of monetary policy, but also the belief that you could assign instruments and somehow separate the use of fiscal and monetary policy. Fiscal became about resource allocation, money became about counter-cyclical, and you could leave that to the central bank. Whatever the merits of that in an inflationary era, where you were more or less at full employment and creeping inflation, and then sudden inflation when you had terms of trade shocks, it's much less clever when you are in a world of, as you say, potential excess ex-ante supply of savings and something of a deficiency of demand, where exclusive use of monetary policy leads to these extraordinary asset price inflations for relatively small return, perhaps, in the level of activity. And you've got to think that actually, surely there are useful things the government could do, and that if they did them, fiscal policy could play more of a role in this situation. And of course, that has now happened by brute force because of COVID and all of that. But it does require a coordination of monetary and fiscal policy. And I think the death of the policy assignment, the policy instrument assignment sort of regime where we could regard fiscal and monetary policy as separate things. Now, my paper certainly bears on that issue of coordination, but it takes a somewhat narrower focus, because I'm looking at the fact that actually government debt isn't what you think it is. Because of QE, 30% or more than 30% of government debt is actually held by the Bank of England. So it's money that the public sector owes to itself. Now, the conventional story is, but when the Bank of England buys all those bonds off the public, it creates money. It writes checks. Those people pay checks into their bank, and they end up back at the Bank of England as commercial bank reserves. These are a liability. They're a liability of the central bank. So public sector debt isn't changed. All that's happened is you've turned what was a bond, a fixed dated bond, into a perpetual debt to the commercial banks at a sort of floating rate. Now, if you think about that, it's very odd because that debt cannot be repaid. I mean, if the banks come up to the central bank and say, all these reserves you got, we want them back, what would that mean? How could you pay them back? They are ultimate money. They are high-powered money. That's it. You're done. So the question is, in what sense is this a debt at all? Now, it isn't, because in fact, what's happening is that the commercial banks are not doing the central bank a favor. It's the other way around. The central bank is acting as a clearer and a lender of last resort. It doesn't have to pay interest on that debt if it doesn't want to. The banks can't get rid of it anyway, unless they're paying back, unless their clients are paying back money to the government. Yeah, there it is. So how would you value a debt that can't be repaid? And the answer is, well, of course, the only sense in which it's a liability is if you're going to pay interest on it, in which case the value of that is the present value of the interest payments that the central bank will pay, which immediately tells you that 30% or more of British government debt isn't a fixed debt, it's a contingent liability, which depends on how the economy develops in future and what interest rates the central bank thinks it has to levy, but also the methods of monetary control, because at the moment we have a method of monetary control that threatens to be wildly extravagant, and I would argue needs to be changed for changed circumstances. Since 2006, the Bank of England has tried to control short-term interest rates by paying interest on bank reserves, on the grounds that that presents the opportunity cost to the banks of lending to the private sector. And if I want to restrain lending to the private sector, I jack up that opportunity cost. And that will be then echoed in the bank's lending rates, and that will choke off or credit and demand. Well, that's not bad in normal situation where banks are trying very hard and on the whole succeeding in not carrying any reserves at the central bank, so you're not paying them anything. But they've currently got £800 billion worth of reserves. And if the only way I've got to control interest rates is by paying interest on 800 billion, I can very quickly, if I'm putting rates to say 5% or something, not a current issue, let me say straight away, not a current issue, but who knows whether, if and when we get back to a period where inflation control does require higher interest rates, if I'm starting to pay 5% on 800 billion, I'm forking out 40 billion a year to commercial banks for nothing. I mean, opposition politicians will have a field day. Why are we paying these swine $40 billion a year, pounds a year, just to control interest rates? So it seems to me that you have to think again about our methods of monetary control. And if you do, you instantly reduce the size of the government debt because it's a contingent liability. Now, there are two ways to do it, or there are many ways to do it actually, but there are two that are sanctified by experience. One is you just reverse QE. You just sell all those bonds back to the public and drain the reserves. And I'm pretty confident that that's what the Bank of England will be tempted to do. Of course, it does mean you lock in. I mean, given that governments don't normally try and extinguish debt except at maturity, this will almost certainly lock in large losses in bond trading. I mean, the bank has already bought bonds at above their face value when interest rates were low. If it now sells them at below face value when interest rates are going up, we'll clock up a few hundred billions worth of losses on that. So I don't think that's ideal. the other way to do it is to sterilize those reserves, which is regarded as a very wicked suggestion in financial circles, because it's taxing the banks. Well, not really. What it's taxing is the banks using those reserves to expand their balance sheets. But that's exactly what you want to do. So, I mean, that is the whole point of monetary policy. We're trying to stop them lending. So if you're putting in effect a tax on lending, what the heck is wrong with that? So it seems to me that the obvious policy is to reintroduce the old notion of special deposits, where you say to the banks, look, you got all these reserves. Well, sorry, X hundred billion of those reserves are a special deposit. We're not paying any interest on them. We'll pay interest on the margin, and we'll pay interest if you have to borrow reserves from us. But on that lot, we're paying nothing, and you've got to keep them there. Now, if you do that, of course, then the cost of raising interest rates to the public exchequer becomes a great deal smaller. Maybe our debt is 70% of GDP or 80%, not 100% for what that's worth. When this was done in the past, people...
Jerry, can I just sort of get you to wind up? We're getting towards the end.
Yeah, sure, okay. When this was done in the past, the complaints were that it led to disintermediation. It led to the grey markets and drove deposits out of the banking system. There are ways to, I think, offset that effect. You'd make the special deposit a lump sum, not a proportion of the deposits, for example, of the bank's of customers' deposits. But I won't go into the detail of that. I think what I would say is the distortions that you're not able to ameliorate are probably not bigger than £40 billion a year, which is what you might be ending up paying if you didn't do it.
Thank you very much, Jerry. Sorry to cut you off. It's a fault of what we have is a very rich agenda today, but clearly, sure. Just summarising that session, there's some clearly important issues raised about what we mean by debt ceiling, what framework do we need as we come out of recovery, how are we going to manage the interest rate risks from QE exit and the extent to which that might broil bond markets. I think that's incredibly interesting. We've also had some questions come in related to that, really about how dynamic a problem is the level of debt. We might not worry about it now, but I think Ben Zarenka, who we spoke to earlier on in this work we've been doing, worries about the ratcheting up effect, which we've seen in other economies. We've seen it in Italy and other places. If you don't address debt levels at one point, there's always another shock on the horizon, and when that comes along, then debt goes up to another level. But again, we might argue, if we look at the Japanese experience, that high levels of debt maybe don't matter as much as we once thought. But I think these are some of the issues that have emerged in the last half an hour or so. If I might, just to stick to the timetable, we're a little bit running over a little bit, but we can catch up, is I'd like to take some of those thoughts and some of those excellent presentations from panel one, Joe, Hande, Martin, Philip and Jerry. That was phenomenally instructive. I learned a lot listening to you all. If I could turn to the panelists for the second session now, which are Ricardo Reis, the A.W. Phillips Professor of Economics at the LSE, Janet Henry, the Head of Global Economics at HSBC. I should apologise on behalf of Janet, whose internet connection, probably because all kinds of trades going through her machine. I mean that as a joke, but there may be some weakness on her connection, but I hope we should be able to stay on long enough to make her intervention. Professor Bart van Ark from the University of Manchester, who's the Managing Director of the ESRC's new Productivity Institute. Danai Kyriakopoulou, who is the Chief Economist at OMFIF, as well as the Chair of their new Sustainable Policy Institute. And finally, but in no means least, Adrian Pabst, Deputy Director of the National Institute for Social Policy and Political Economy. Ricardo, if I may start with you, but may I also just publicly congratulate you for the award of the Eero Johansson Award, along with Silvia Tenreo. We were delighted as UK macroeconomists to see you and Silvano get that award. Really very pleased, Ricardo. My congratulations publicly on that.
Oh, thank you very much. Well, thank you especially for being part of this panel, because while now I have to do a little bit of work, I had the treat of getting the early copy of the report a few days ago, which I think will be released just today. And it was really a pleasure to read it, to think through its issues and both its more provocative recommendations as well as its more sensible ones. It was really a joy, and I would like to strongly recommend that all do read it. I want to make two major points and maybe one very small one in these few minutes that I have, which are very much inspired by the report and therefore in some ways expand on some of its topics, having to do precisely with the fiscal framework and how to think about it in the future. The first point is, what is the role of an institution like the OBR? And I don't mean this in abstract, what is its role, but rather starting from what we have now, how to perhaps improve it, make it more relevant, and make it such that it brings more stability and interacts with the Treasury and more generally the budget process in a way that makes the whole thing especially more transparent, more accountable to the public, and reduces the uncertainty as it applies to budget and tax policy. One important role that the OBR performs is that of forecasting the future in order to, through forecasts of future output, be able to derive, among other macro variables, be able to derive paths for future revenue, tax revenue, as well as many transfer spendings, which will then serve as extremely important inputs into understanding the impact of different policies. Now, forecasting is a very hard business. The National Institute, hosting this panel, is partly in that business and is a very frustrating one and a very humbling one. But to some extent, while one could talk about how the OBR could improve its forecasting process, I think the best advice one could give it is to talk more to people at the National Institute who have been doing in this business for a few decades in terms of how to perhaps improve it in some dimensions or not. But as importantly as those forecasts of the inputs is to think about what are the consequences, the potential consequences of different policies. And that is a business that in many ways macroeconomists are somewhat more comfortable about, because that is a business of counterfactuals, of projections of the effects of policies, as opposed to unconditional forecasts. Now, moreover, that business comes also with the slightly nicer outcome that, unlike unconditional forecasts, you can't really completely compare them to data and say if they are wrong or right. Why? Because they're, after all, projections, ceteris paribus projections of what this particular policy does or not. Now, when it comes to fiscal policy, these projections are already commonplace. Excellent places like the Institute for Fiscal Studies and others regularly, whenever a policy is announced, say how this will cost these people some amount and benefit some other people some other amount. Again, always very sensible projections, none of which can ever really be tested ex post because, well, in the meantime, lots of things happen to different groups. And as a result, there's never either wrong or right, but an extremely useful input into policy. Well, likewise, at the macro level, a key input is precisely to understand to what extent do different policies, budget and otherwise, what do we expect that their effects will be of these different policies, of these different counterfactuals in macro variables. Now, the OBR, the report that follows with this panel suggests that the OBR does more of this, and I would really double down and say that it should do a lot more of this. Use good macro and, well, not just macro, use good economics to do more of an assessment of, and this goes also combined with the recommendation in the report that fiscal policy can be a little more predictable in terms of a calendar, in terms of when things are announced. And so that also leaves space for the OBR to do this analysis and show what different consequences of policies are. After all, policy is all about trade-offs, and making those clear is an important part of being able to have not just intelligent discussions about policy, but also accountable ones that reduce the uncertainty. Now, a well-known difficulty in making those projections is, well-known I say because central banks have been doing them for many years, is what do you forecast policy itself will be in the future, as that will be an important input in itself. Now, in monetary policy, that is a difficult. Why? Because on the one hand, as an institution, you don't want to be committing your future selves in that institution to what policy they will do, nor do you want to be revealing, if you want, hints on what you think is more likely or not in terms of what will be your own policy. That is, you don't want too much to be forecasting yourself, for after all, that is nothing but commitment and discretion that policymakers may not want to do. Now, for the OBR, that in some ways would be even more complicated insofar as we'd be trying to forecast whatever it is that the Treasury will be doing, and that would not only be politically sensitive, but just generally not necessarily adequate. However, a suggestion made in the report, which I would endorse, is making counterfactual predictions under different scenarios for policy. In particular, one that I would like to see, and one that I think would be quite important for policy, is to make different assumptions on which discretionary policies are permanent versus transitory. We already mentioned, or Jagjit just mentioned a little while ago, the extent to which one-off discretionary spending has a nasty habit of becoming, if not permanent, at least very persistent. And that is part of the ratcheting effect on public debt that we seem to experience across the OECD over the last 40 years. Making forecasts of what policy will do, not just if given what is being announced by the government in terms of how the policy will expire, but also under scenarios in which the policy persists longer or shorter, is, I think, much safer ground for an independent institution to do. And that would provide, I think, important benchmarks that would make fiscal policy more predictable, its effects on the budget, as well as its different effects on policy. So that'll be my first point, which is that projections are important, counterfactuals are important. We have the tools to do them more than forecasts on which we spend perhaps too much energy. These different projections, which have proven to be so useful in the monetary policy setting, to the extent that those projections are even often the benchmark of an inflation targeting report, as happens at the Bank of England, and even of explicit inflation targeting, as happens, say, in Norway. Those would be, I think, an important step in being a tremendous amount of transparency. In the same way that we have an inflation report, we can have the OBR reports be more focused on different counterfactuals relative to what they are now. My second point has to do with countercyclical policy. The world seems to have changed in the last 20 years in terms of macro stability, because on the one hand, we are living through a great moderation in the sense that the quarterly variance of most macro aggregates is much lower than it was in the 1980s, say. But on the other hand, every 10 years, we now have gigantic recession. In some ways, the macroeconomy has become more about disasters than about cycles. An old discussion in economics of how should we think about the business cycle. Well, there's been quite a change in that now counter-cyclicality, if you want, or recessions are really more about disasters, rare, very large events than cycles. Now, on the use of fiscal policy, counter-cyclical policy, note that in its management of actual general cycles, I have to say that as much as there's been research in the last 10, 20 years to the extent that we should be using more as opposed to monetary policies in the previous consensus that was already mentioned, not much of it has actually been empirically all that convincing. For cycles of, let's say, normal amplitude, the business cycles that we experienced in the 70s, 80s, and 90s, it continues to be unclear that fiscal policy would have done a better job than monetary policy. So I would say that at the same time, though, when it comes to disaster response, their fiscal policy is very important. So I would compliment to the previous speaker who said that, well, the world is different now because of inflation having changed. I think the world is different because the type of recessions we're getting is very different. Now, when it comes to disasters, fiscal policy then has an important role as ex post social insurance. It is important because the moral hazard that leads us to if you want, the micro level moral hazard that leads us to often object to fiscal policy or to a fiscal policy that provides too much insurance is less relevant when we talk about the macro side. Indeed, it may actually work in the opposite direction. It is because people don't expect the government to step in during disasters that leads to too much animal spirit savings that deepens recessions. It is insofar as people don't expect the government to keep supply chains and to prevent long-term scarring of recessions that they then become very worried about firing and closing their business quickly because they expect that the recession may persist more than not. So in that sense, the moral hazard goes in the other direction, in that the government should actually do more rather than less when it comes to these disasters. In that case, though, what becomes crucial, and I think Martin Ellison mentioned it earlier, is the transition in and out of disasters. When we enter a disaster, as in, say, 2020 and 21, the government has to really step in. Speed, accountability becomes crucial. Something the report brings in is the need to then do a little bit of ex-ante planning for different shocks so that we don't end up doing things that are too much on top of one's knees, improvising far too much as we have in the last 12 months and giving an enormous amount of discretion to policymakers given the speed and urgency, while at the same time knowing that there's a need to transition from disaster to non-disaster time, and in doing so, be able to go back to a point in which, in the normal small cycles, monetary policy is king and fiscal policy is less. So those are my two main comments. I'll leave the rest up for the discussion. But for now, one, the importance of projections, and two, the importance of starting to look at fiscal policy as disaster response, as opposed to cyclicality, and that confusing the two, as often happens in discussions, I think may lead to potentially bad outcomes. Thank you.
Thank you ever so much, Ricardo. Very animated and helpful contextualization of our analysis. Thank you for that, Ricardo. For me, I'd like to turn to Janet Henry. Hopefully we can keep her on while her internet connection is stable. Janet, if I may turn to you now. Thank you for waiting. Okay, thank you very much, Jagjit. Can I just check you can hear me okay? Very good, very clear. Very good, okay. Hi everyone, clearly I'm the financial market participant here. So I'm just going to make a couple of comments on the interaction between fiscal and monetary policy. And I suppose this was also a point that was raised in the foreword that Norman Lamont wrote in this report regarding bond market vigilantes. And I suppose also it relates to a recurring theme that a lot of people have talked about, which is that, you know, should there be something about how fiscal policy would respond if any alternative scenarios materialise. So as far as central bank independence is concerned, we all know the case for central bank independence. It is designed to prevent governments from being irresponsible with their policies and tailoring them to the electoral cycle. And obviously we've had central bank independence for more than a couple of decades now, and it has been fairly clearly defined. Central banks simply took the fiscal backdrop and tried to fine-tune demand. And I think as far as financial market participants are concerned, they understand that the pandemic is an extraordinary situation, that the time has come for much more coordination between monetary and fiscal policy, that central banks are right to have, I suppose, provided large amounts of liquidity to sovereign bond markets and indeed financial markets have embraced that. So we have, of course, seen this surge in financial and tangible asset prices around the world. But I think certainly that there is starting to be some concern. You know, over the last few months, we have seen financial markets be a little bit skittish from time to time, that this might actually be the start of some kind of slippery slope. They're even starting to question, and I suppose this is a broader context rather than something just about the UK, they are starting to question whether governments could be putting some pressure in time on central banks to keep the rates low, even in the face of higher inflation. And I think what's very clear in the report, and indeed the comments made in the previous panel, is that as useful as fiscal rules have been in the past, they have all been based on assumptions which at some point have unravelled. And again, not just in the UK. And they've unravelled because stuff happens that we don't expect it to. So yes, there has been this world of the last decade. And I hear the optimism from some of the earlier speakers regarding a very low interest rate world where nominal growth is higher than that low nominal interest rate, and we all make our own debt sustainability analysis where debt to GDP ratios you know, are sustainable as long as interest rates do not rise. But I think this does bring me to the question of, I suppose, what do participants in sovereign bond markets look for in fiscal frameworks? Yes, they are aware of the situation. Their base case is probably not that we're going to see a surge in inflation, but they know that the probability of higher inflation has shifted somewhat globally, even if it's primarily led by the US. And I think this does relate to the points made earlier about global interest rates being set, and even interest rates in the UK being primarily driven by what's happening at the global kind of level. So I would say, as far as sovereign bond market participants are concerned, and what they look for, they do react to the mix of spending, whether it's transfers or areas that might be productivity enhancing.
although I do recall Joe's comment about actually higher public investment actually coinciding with a slump in productivity. But what we have seen obviously in recent months is that something that's kind of tax financed rather than deficit financed, something that's aimed at infrastructure rather than just transfers, that the market does respond somewhat differently. But more broadly, I think in terms of the risks that they're starting to discuss and to price in is the risk that in time we could see some degree of fiscal dominance. As I say, it may not be their base case, but they are wondering whether central banks will have the full autonomy to act, given what it would mean for higher interest rates. Obviously, Jerry's come up with some alternative scenarios to try to prevent the cost of borrowing rising, but would they actually be able to raise interest rates with the view that it could obviously impact on fiscal sustainability? So what I would say as far as bond market vigilantes are concerned, we know that financial markets, how they respond to fiscal dynamics is not linear. Moves in bond yields can be abrupt, and if yields are suppressed, even in the face of higher inflation, should that happen, instead it can lead to dramatic declines in exchange rates, and we haven't heard much about exchange rates so far. So I think we need to realise that even if it is reflected in a fall in the exchange rate, that adds to the inflation risk, and obviously in itself reflects a reduction in real living standards. So as far as fiscal framework, new fiscal framework, I've no doubt it will imply a need to set out something that will stabilise the debt to GDP ratio in the not too distant future. But I think, and this is something that's alluded to well in the report, that it's the alternative scenarios, and for financial markets, what would happen in the face of higher interest rates? What does that do to debt to GDP ratios? How might policy respond, and what kind of economic scenario might we face as a consequence of that coming through? I'll leave it there.
Thank you very much, Janet. So just briefly before I go on to Bart, I wonder if just ask you on the back of Philip's analysis of the demand for sterling assets. And I know you can't speak on behalf of all the financial markets, but to what extent is the level of UK debt a concern in the peripheral vision of bond markets at the moment? Is there any sense in which they are especially concerned about the level of debt and the way it's ratcheted up in a country such as the UK? Have you picked that up from the kind of reports you read or the people you talk to?
Financial market participants always struggle with the cyclical versus the structural. You go through periods when people look at the UK and say the double deficits, and especially when there are areas of political uncertainty, that perhaps it should be viewed with a kind of emerging market kind of overlay. Currently, most participants are looking at the UK a bit like the US. It's at the beginning of a cyclical upturn in activity. The vaccination rollout's coming through. It's going to be one of the earlier central banks to taper the asset purchases, which should get away from that idea that they are just fully backstopping the government with the scale of asset purchases that are coming through. And as they scale back the pace of asset purchases, no, the UK, there is not a particular focus on the debt to GDP ratio in the UK.
Yeah. Thank you, Janet. Very helpful. And thank you ever so much for joining us this afternoon. If I may go up to Manchester, feels like the Eurovision Song Contest, but I go up to Manchester. Professor Bart van Ark, the Managing Director of the Productivity Institute, is extremely well placed to answer the question about what fiscal policy can do for productivity. But Bart, the floor is yours for the next few minutes to have your intervention really on where you'd like to see the future framework go. Bart.
Thanks, Jagjit, and thanks for having me. And I hope the audience is not yet exhausted by all the excellent comments made so far, and I'm sure there are more to come after my presentation. So I'll try to be quick, but there is so much interesting to say about this report. I was asked to speak to this from the perspective of productivity. And obviously that means that you need to think about the medium to long-term perspective. So a lot of my comments are about the needs that's been emphasized across the report about the medium to long-term focus for fiscal policy rules. By now, you will all be familiar with Krugman's quip of, productivity isn't everything, but in the long term, it's almost everything. And indeed, if fiscal policy is short-term focused, then productivity actually, as a policy call, doesn't really matter. Productivity is very volatile in the short term, particularly now. And while a spending boost in the next few months can temporarily create a nice cyclical productivity effect, it mostly doesn't really shift the supply side factors in terms of more human capital creation, in terms of more innovation and technological change. So in other words, any kind of short-term focus on productivity doesn't get the structural change underway that drives productivity growth in the longer term. So I want to make a few quick remarks about this medium-term focus from three big challenges we have ahead of us. And I think they were all three already mentioned in earlier presentations. First of all, the recovery from the pandemic. Now, as we get out of the worst of this crisis, there is, of course, the short-term temptation to wind down business support programs and furlough programs very quickly. And doing this drastically by abruptly abandoning those programs over the summer could, in fact, boost productivity through a shock to get rid of zombie firms or other firms that are underperforming. However, such a shock therapy would only sort positive results if the conditions are there for surviving and new firms to grow, that they have access to human capital, that there's the hard and digital infrastructure they need, that have access to the financial instrument to grow, that the innovation ecosystems are available. And without those conditions, and I think in many cases those conditions aren't there, the short-term shakeout therapy is likely to raise inequities in the economy. Well-funded firms, large firms will do great. Those which can get by with very little in terms of low wages and weak innovation, they might survive, but a lot of firms will probably die simply because they run out of cash or out of funding. So we really need to rethink about what the longer term implications are of winding down these support programs. The second topic of medium term challenge is, of course, the leveling up program. And to do this, we need to really address the key areas of underinvestment from a productivity perspective. Human capital, knowledge capital, and infrastructure were already mentioned before. But investment for productivity isn't really just about the size of the actual spend. It's actually about the returns or about the efficiency by which we put those public resources to use. And to assess that, that's a really big challenge. Returns on public investment are quite often proxied by some kind of cost-benefit analysis, which in turn depends very much on how many parameters you're willing to take into account. So, for example, how do we compute the productivity spillovers from investment, which ultimately gives us the longer-term gains? What are the complementarities between different types of investments in skills, in infrastructure, in technology, which all sort of play on each other? When is something a public spend and when is it an investment? And how do we think about, for example, the spending on education or other types of intangible investments, and what are the implications of that for borrowing instruments? And then, of course, there's the regional element of leveling up, where clearly a kind of one-size-fits-all fiscal policy doesn't work. Setting a national R&D target of 2.4% is not very helpful in the light of different needs across regions. And that's why at the Productivity Institute, for example, we try to analyze a lot of these issues at a regional level to really understand where the biggest needs for policy support and fiscal support are. And then the third fiscal challenge, obviously, of the medium-term challenges, obviously has to do with the net zero target economy, which actually wasn't discussed all that much so far, but perhaps is one of the biggest public policy challenges we have ahead of us. And I could say a lot more about that, but there are lots of questions here from the perspective of productivity. But just for the sake of time, I'm going to refrain from that. So these three main areas for a sort of workable medium-term fiscal policy framework are really important in this sort of time of these vast transitions. So 4 very quick comments to wrap up. First of all, I really embrace the recommendation in the study that the fiscal strategy has to be joined up across the UK and that all constituent parts need to be addressed and that we need to pay particular interest to productivity, distributional effects, to well-being and ecological sustainability. So thinking about the joining up of fiscal policy, I think, is of critical importance. Secondly, dealing with uncertainty is really important, particularly when it comes to productivity. It's very hard to predict where technology is going to take us and what the effects of innovation in the longer term will be. So this recommendation that we need to get a guidance that is related to how we manage risks and uncertainties, to build in a certain amount of flexibility to respond to new developments, I think is of critical importance from a productivity perspective. Third, a big question in any fiscal framework is how to deal with the question of the productivity trend, which was mentioned earlier. And that plays directly into the measurement of potential output growth. And that's a minefield, as the National Institute knows very well. And we can currently see it playing out in the United States with the impact of the massive fiscal stimulus program that we're seeing there, the impact on inflation, but obviously, ultimately, the impact on the long-term real economic growth. I much favor the recommendation for this new body of independent experts for ex-ante and ex-post evaluations. And at the Productivity Institute, we actually made a first start by that, by launching a productivity commission with independent experts that are hopefully going to be a place where we can provide a lot of evidence-based analysis on how this policy agenda may impact on productivity growth. And then finally, we all understand how different these policy objectives are, but there is, of course, a risk of fragmentation if there are too many. When I was preparing this comment, that was perhaps my biggest worry. Maybe we're putting so much a burden on a good fiscal policy framework that there's just too many cooks in the kitchen, and it will be very hard to do. So I think setting out a sort of long-term strategy with clear guardrails around the policy framework, and within those guardrails, a lot of flexibility to respond to short-term and medium-term deviations, I think is going to be very important. So all in all, a lot of food for thought here, very important from the agenda of the productivity agenda for the UK. And thanks to the National Institute and all the contributors for making such a good start on this debate.
Thank you very much, Bart. Such a rich set of presentations this afternoon. I'm going to have to listen to them again and again to absorb all the points, but absolutely wonderful from everyone. Thank you ever so much. Denai, may I turn to you now from OMFIF?
Thank you, and good afternoon to everyone. Congratulations on this report. To echo Ricardo's comments, it's a great report, and I encourage everyone to read it. So coming from a more monetary background, for those that don't know, OMFIF is the official monetary and financial institutions forum. We work very closely with central banks, and I recall before the pandemic hit, we were having a lot of conversations with central bankers, and in that in the forums that we were organizing around what would the role of central banks be in the next crisis. And the predominant concern around these discussions was, will central banks have run out of policy space in the next crisis? Interest rates are already at the zero lower bound. They are the only game in town, but what role will they play in the next crisis? And I think we've all been very surprised to see how innovative they have been and how much active players they have continued to be. But the real game changer in this crisis has been that they have not been the only game in town. And in most jurisdictions, in the US, in the Euro area, and the UK, we've seen fiscal policy really play a very important role as well. So I think that's the first thing that I would say in terms of where we are now in this crisis. And I think the idea from Ricardo that it's a disaster response mechanism has also been proven very relevant in this crisis. And also what Clare was saying in the very beginning about fiscal policy being back and paying more attention to it. I think also we can draw some lessons from monetary policy to fiscal policy, and I was interested to see that the first building block in the report about future frameworks is more about communication and kind of timetables and communicating fiscal policy. And I think that's very important because one of the things that we have learned in the monetary policy conduct in the past decade or so is that communication can be policy, and I think that is something that fiscal policy may also beginning to learn more directly through becoming more active in this crisis. Then thinking about the future and the future of fiscal frameworks, which is the subject of this panel, I think one key question is the blurred lines between fiscal and monetary policies, and some of the speakers have already touched on this. Janet, Jerry have touched on the issue of how will we see fiscal dominance? Will there be a situation where the fiscal and monetary policy are in tension when interest rates begin to rise, and how will central banks respond to that? We've written about this, and I'm happy to put a link in the chat as well in terms of how will this problem arise. And I think it's important to think about the macroeconomic environment in which we would have such an issue at a kind of low growth, high inflation scenario, which still doesn't look the most likely outcome. I think also to think about the legal framework around the interest of reserves and how central banks can respond to something like that. So what options they would have in their disposal, unwinding reserves before raising interest rates, for example, tiering reserves or funding interest payments to more reserves. These are all options that could avoid this fiscal monetary tension that some of the speakers have spoken about. So looking at both the macro environment and the legal environment, I would say that I'm less worried about this issue of fiscal dominance on monetary policy, but still it is something that could become politically very relevant. And I think thinking about future fiscal frameworks is something that is very relevant to discuss. Then I think the second question around fiscal frameworks is also the question around sustainability. And again, some speakers have already spoken about this, the debt sustainability, and how do we think about this, how do we comment on it? And clearly the press or the public discourse around this is focusing very much on the high debt levels that we're seeing in this crisis, the unprecedented levels of borrowing. But I think it's important to keep in mind that it's a ratio, debt to GDP. We also need to think about the growth part of the debt to GDP, and also looking at debt, not just about the levels of debt, but also the conditions around it. What are the borrowing rates at right now that are at historic lows? What are the borrowing costs and the gross financing needs of advanced economies? Who is the debt owed to? And in this case, in many advanced economies, the share of debt that is owed to the central banks has gone up a lot in terms of central banks becoming bigger holders of government debt through their asset purchasing programs. So I think these are all very important factors in understanding in a bit more nuance the debt profile, which are not often in the headlines, maturity levels of debt as well. And then finally, to think more about the future also is another disaster that, to use Ricardo's frame of thinking, that is coming, and that there are crises that are coming outside of the financial system. Unlike the previous crisis, we are now in a pandemic, but non-financial sources of risk also include climate change, for example, and rethinking about what is the role of fiscal policy in addressing not just productivity concerns, but other market failures or non-financial sources of risk where fiscal policy can play a very important role. And central banks have been very active in making efforts in this. They have been adapting their stress tests, for example, to account for climate, or to tweak their reserves management, portfolio management strategies to account for these factors. But I think is also an area where we can see more from fiscal policy. And we've started to see that in the UK, in the Euro area, with the Green New Deals and rebuilding the economy in a more sustainable way. And I think this goes back to the very initial remarks that Tim made about how we think about the economy, managing limited resources and allocating them in a kind of flow focused on GDP framework versus thinking about other variables such as well-being, such as sustainability, thinking more about the stock as well. So I'll close there and look forward to the discussion.
That's excellent. Thank you very much, Denai, for covering those things. It's clear that you're bringing a rich analysis of the monetary sector and asking a similar set of questions of fiscal policy. And the question we consistently have is, how can we keep fiscal policy on the agenda long enough? Because of financial markets' interest in the cost of borrowing and setting bank rate, it's always something that comes up at NIESR. Everyone's worried or thinking about where bank rate might go. How do we bring about a significant constituency of people who are openly interested in these things on a consistent basis? And it could be communication timetables may help some of that. We have a relatively small community of people thinking about these things. So I'm very hopeful on the back of our discussion today, we can build more of that analysis. And I think everything we've heard so far supports the level of interest that we think there is in these issues. If I may, to wind up this session, I'd like to turn to Adrian Pabst, Deputy Director for Social Policy and Political Economy at the Institute, who I think will summarise some of the points that we have in the, I like Claire's word at the beginning, volume. I quite like that word. It's a good, I have to remember that word. We couldn't decide beforehand, was it a book or a report, but I think you nailed it with the word volume, Claire. Thank you. Volume. Adrian.
Thank you very much, Jagjit. I stand between you and Q&A and Richard Hughes, so I'll try and be brief. We've had some very, very rich presentations and some absolutely fantastic contributions in the volume. So you know, in some sense, one might suggest nearly everything has been said, but not by everyone. So let me add a few thoughts to our discussion this afternoon. One recurrent theme in this session, and indeed in the book, is the importance of objectives for fiscal policy, and that these objectives aren't just deficit and debt management based on rules. And that's because targets are often moved by politicians and policymakers, and rules are often changed. And that in turn introduces uncertainty just when fiscal policy should provide a source of stability and predictability. And therefore we are arguing, as indeed are many people in this session and in the volume, that fiscal policymakers should pursue a broader set of goals. We've just heard from Hande about the importance of sustainability, before that from Bart about productivity. And we are saying that fiscal strategy, and that's the first proposal we're making, has to be joined up across the United Kingdom. That means all of its constituent parts, the devolved nations, as well as the different regions within England and across the United Kingdom, because we know how much the regional dimension has recently played into political and policy decisions around, not just Brexit and COVID, but also before that, how austerity has impacted the economy, but also, periods of expansion, and where perhaps industrial and manufacturing capacity was not always built when it was actually needed. We have to pay attention to distributional effects, as has been mentioned by Tim and by others, and indeed well-being. So therefore, it shouldn't even be just growth or GDP that fiscal policy aims for, but also richer measures of well-being that have to be built into policymaking. I think Wales has tried an interesting path here in terms of how that can be done, including through some legislative changes. But to help achieve these ambitious goals, we also need a different fiscal strategy and setup, one that is more robust and capable of responding to long-term challenges as well as short-term crises. And we think a more informed debate based on coherent economic theory and evidence is really needed. So we're not calling for a radical revolution, but also not just for marginal reforms. We're really calling for a wholesale transformation of the current strategy and setup. One of that element, and it's another proposal we make in chapter 1, is for Treasury to set up a new body of independent experts for both ex-ante advice and ex-post evaluation. Now, this is vital. It's a bit like SAGE for, I think, the economy and fiscal policy making. And we are agnostic about whether that should be on the model of the US Council of Economic Advisors or the German Council. But what is important is that experts independently can say what some of the best policy advice is out there, and also can evaluate the choices that were made. Now, another proposal that ties in with this is the importance for the OBR, we think, to publish pre-fiscal event reports so that the key issues can be laid out, and then the budget and the autumn statement, and indeed comprehensive and other spending reviews should then respond to some of those issues that have been laid out. Again, that would raise the level, and we think improve policy choices. Now, those policy choices, let's be very clear, will always ultimately be political. They will be choices made by the Chancellor and indeed discussed and approved by Parliament. But we are interested in essentially a higher level debate that we've had, with more ideas and more evidence coming into the frame. And therefore, another proposal, this is our fourth one, that we're calling for, is for the Chancellor to provide more guidance as to how fiscal policy would respond if different risks materialize. And that then means we would like the OBR to produce economic forecasts and scenarios to inform government on those different fiscal choices, depending on which scenario comes about. And finally, and again, this goes to the heart of fiscal policy making, along the lines that we're suggesting, the Chancellor shouldn't just announce a series of policies and indeed potentially have them leaked and previewed before the budget speech is developed. Rather, what we would like to see is a budget speech focused on the state of the economy, so very clearly engaging with what the economy is doing, where it's going, and explaining the government's socioeconomic objectives. And we would like that budget then also to be extensively discussed and scrutinized by Parliament and by an independent fiscal council, rather than the current process, which we think doesn't do full justice to the really, really important economic and indeed ethical choices that each government has to make. Thank you very much.
As a professor of politics, I mean, do you feel this is on the right balance between maintaining democratic accountability and decision-making by politicians, but introducing, perhaps, can I use the word rigor or analysis, and setting out of the alternative choices that are being faced? There's a sense in which one almost feels like once we've gone into the Purdah period, policy is just announced and that's the end of it. And there's very little discussion because the news cycle has been managed to the point at which no one wants to talk about it anymore. Is this a way of deepening and lengthening the debate? Is that what we're picking up here, Adrian?
Yes, I think it is about deepening and lengthening the debate, but also improving its quality so that we are not operating just on the short term. That is the short term of the news cycle or the short term of even an electoral cycle. We are saying economic and fiscal policy in particular has to do with the long-term decisions as well. And we have to somehow inject more long-term thinking into the process. And the other thing I think that matters here is that politicians, I think, now know that they are facing a crisis of trust and credibility. We rightly or wrongly, but that's the perception. And I think we could help restore credibility and trust in politics, in policymaking, if there was a much more informed, higher quality debate that actually addressed some of those long-term issues, as well as, of course, being nimble in responding to short-term crises. As Ricardo was saying, it is sometimes about disaster management. But we can't just do the short term, and time isn't just a juxtaposition of the short term. There has to be the long term. We know this for productivity, but we also know it for questions of well-being and indeed for health. And we can now see that when we don't have industrial and manufacturing capacity, we are not able to respond to a short-term disaster like COVID because we simply don't have the domestic production for it. And that, I think, should be a very serious lesson to draw from the current crisis.
And how would you draw up an overall measure of the economy? If GDP is not enough, what kind of template or set of indicators, or how would we monitor progress, do you think? Because I think we've had various attempts to measure well-being in an index, and I think they've been questioned by most people, even those who've constructed it, and that may not be the way to proceed. So what kind of overall set of measures might we be monitoring, and how would we encourage that to be assessed year after year? Have you any guidance for people who may be listening to this?
I think it's a crucial part going forward, and I think it's right to say that we haven't got at the moment a wholly satisfactory index. But I think what we need to get to is to try and measure much more the well-being of individuals, of groups, and indeed of the whole of society. But also, I think we have to find ways of combining quantitative with qualitative evidence, so that we are not just able to reduce this to numbers. The numbers will always be a very, very important part of this, but that we are able to set out a conceptual framework by which we will judge the qualitative evidence that we can also derive. And I think well-being ultimately cannot just be captured by numbers. Numbers are necessary but not sufficient. So we need to be able to develop also the quality, if I may say so, of qualitative evidence to really reflect how people can flourish and not simply reduce this to GDP or income per capita.
Thank you, Adrian, very much. A couple of minutes, we're going to turn to Richard Hughes, the chair of the OBR, the Office for Budget Responsibility. We have a number of open questions in the list, but we have so many speakers who could say so many brilliant things about these questions. I'm concerned we won't have enough time for Richard. So can I make a point and state clearly to all the people who ask questions, we will come back to you with some answers, but I want to certainly give Richard enough time, and perhaps I can kind of encapsulate some of the questions in some almost completed sort of final comments from me about the report. And I think one thing that coming up listening to all the insight from people today is the importance of timetables, building enough time to think about the issues that we're worried about and invite contributions from a community of people who care about the UK and its outcomes. And that may just not be those people currently in and around the 1 square mile around Whitehall. Of course, the National Institute is within that 1 square mile, but there are all kinds of people around the country who may want to contribute to that decision-making process. I think that's one of the things that we are calling for, are a fixed timetable, not for budgets or fiscal events to be announced a few weeks short of when they're going to happen, but with a much longer timescale. And I think the publication of a fiscal risk or key judgments report would help that, for which comment could be introduced or asked for. We live in an increasing world where academics and others want to have impact for their research, and this kind of initial sift of data and questions could provide a mechanism for people to contribute to the quality of that analysis, which I think would be incredibly useful as we try to wrestle with the complex issues we're talking about today. It's clear the forecasts that we have are done, they're incredibly difficult to do, as I think Clare and others have pointed out. It's something the National Institute's been doing for several decades now. The first forecast was around 1959 that the Institute did. And it's something that we know will turn out to be wrong. But what we try to do is think about scenarios, think about the uncertainties, and think about how we can think about counterfactuals, which involve different views on deep-lying problems such as productivity, as well as different policy statements. And that allows us to understand better the impact of any particular policy that may be chosen, or where we might go subsequently if things surprise, because we know they will. With 2 fiscal events a year, potentially, there will be lots of news to decompose every time between those events. And I think that's a very important part of what we'd like to see introduced, is more counterfactual analysis and more acceptance of the fact that a point estimate of a sequence of deficits can never turn out to be right. It will not be something that actually happens in the future. And therefore, to then condition the GDP path on a sequence of fiscal deficits won't turn out to be the fiscal deficits we have, means we're setting ourselves up for some failure here, which is not terribly helpful. The use of counterfactuals, I think, overseas as well. We had a question in the chat, I think, from James Smith, a long-time friend of ours, talking about the impact of US policy. You know, is that something that might affect global productivity? What of the spillovers for the UK? Are there other lessons we might learn? The Institute at the moment is working on its own global economic outlook, which will come out on the 10th of May. And a clear question there is what more might be done, particularly when we look at the euro area. So are there bits of work that could be commissioned from the academic community to say, well, what would happen if these kinds of policies were done? Can we do more of that and then get that disseminated back to Treasury and OBR so it can be used for the analysis that will be presented at fiscal events? I think that's incredibly important. Adrian, a number of times, and others have talked about broader assessments. The concentration on GDP per se is not terribly helpful. There are wide variations in both productivity, income, and other measurements of well-being, how long it takes to get appointments, the quality of schooling, at the household level and at the regional level. And we need more front and center demonstration of where we stand on these things. Where is the state of the economy address? Where is the thing that says, this is where we are, this is where we were last year, this is where we're expected to be, and this is where I think we'll be in 5 years if we implement these kinds of policies. That would lengthen the horizon of policymaking if those kinds of statements were made. They are generally not made. And I think that's something that seems to be missing. We just need a much broader set of analyses, both in terms of the aggregate numbers that we look at, but in terms of the regional and household numbers. There are reports in there. The Treasury does a great job of doing distribution analysis where it can, but it's often something that is missed by people. So it's not a fundamental part of either the state of the economy addresses, or it seems to us from the outside of a lot of policy making. And we had a lot of discussion today about fiscal policy's role as a structural device. It may not be a high frequency device to stabilize the economy. Think of interest rates in the classical period of 1997 through to 2007 or 2008 as these small movements perturbating and stabilizing this economy. Clearly, fiscal policy doesn't work that way. It takes longer for it to have an impact. There are a more complex set of rules at its disposal. But one thing we know, as well as Ricardo and others have said, is something we turn to in a crisis, and it's something that can affect real allocations. We tend to take as a first pass that monetary policy is neutral with respect to real allocations, real income, real well-being, but fiscal policy we know has distribution and long-term impacts. And so as a structural device than necessarily a short-term cyclical device, all our arguments are focused towards a much longer run horizon for policymaking and a longer run assessment of outcomes. I think that's where I've tried to summarize the questions that have come in and the discussion that we've had in the last hour and 50 minutes, which I will say I will be returning to regularly because of its richness and excellence. Talking about richness and excellence, let me now turn to Richard Hughes, Chair of the Office of Budget Responsibility. I'm very grateful has been able to join us today from what looks like a sunny window in SW1. Richard, can I ask you to pick up really whatever you feel you can and whatever you wish to in the next 10 minutes or so?
Thank you, Jagjit, and not as sunny as the corner of Dean Trench Street, I should say, but much of the very rich discussion, both in NIESR's occasional paper, as well as in this afternoon's seminar, has been about fiscal policy and about fiscal frameworks. And I've really enjoyed it. And thank you very much for the opportunity, both to read the report, but also to participate in this talk. I've written a fair amount on these topics in previous lives, but I'm now the head of an institution whose role is narrowly defined in legislation to producing the official economic and fiscal forecast, and explicitly not provide any advice on the appropriate fiscal targets or policies of the government. And I should say that the task of producing that forecast has been hard enough over the last year without also having to advise the Chancellor on what to do in response to our forecast. So I'm going to confine my remarks fairly narrowly to where I think we as economic forecasters need to learn lessons from the past decade and look to do a better job in the decade ahead. But in doing so, I'll try to echo some of the themes that have emerged from the foregoing discussion as they relate to the forecasting of the economy and to the public finances. And I should stress that my remarks concerning the forecasting profession are about the forecasting profession as a whole, both in the UK and around the world, and are not targeted at the OBR in particular, who, if anything, I think have been at the forefront of innovation and adaptation in the forecasting process long before I arrived. But first, and to simplify only slightly, in constructing our economic forecasts over the last decade, we've tended to think of the macroeconomy as being characterized by a fixed and stable rate of growth and supply, around which shocks emanate from the demand side of the economy and driven by the mysteries of animal spirits which really emerge from outside our models. And this was perhaps a valid way of thinking about the economy during the Great Moderation. But as Ricardo emphasized, in just over a decade, we've seen three significant shocks to three different parts of the supply side of the economy. We've had the financial crisis hitting the banking sector, we've had Brexit hitting the tradable goods and services sector, and we've had coronavirus hitting the non-tradable services sector. And while our current near-term economic prospects depend primarily on how quickly aggregate demand and especially consumption respond to things like the rollout of the vaccine and the lifting of public health restrictions over the next few months, our long-term economic prospects really depend much more on the long-run legacy that these shocks leave behind for business investment and the capital stock, population and the labor supply, and the productivity of all of these sectors. And one way to illustrate the problem of trying to think about the macroeconomy in conventional business cycle terms is to point to the data itself, which shows that in no fiscal year since the creation of the OBR has the estimated output gap ever exceeded 1.6% in outturn, though we forecast output gaps of more than twice that size over the course of the last decade. And at no point over our current forecast horizon do we expect the output gap to exceed 1%, though output fell by 10% last year. So I think that conventional conceptions of business cycles just aren't relevant to the series of shocks that have impaired both the supply and the demand side of the economy over the last decade or more. And fiscal frameworks that are based on these conventional concepts alone are unlikely to afford much useful guidance or flexibility to policymakers. A second and related shortcoming of the forecasting profession has been a tendency to give unduly certain and sanguine view of medium-term prospects. And this is partly as a function of the aforementioned assumption that output always returns to some predefined long-run trend within a standard 5-year forecast horizon such that we use. But it's also because we don't attempt to anticipate future shocks or take account of the government's asymmetric reaction function to those shocks, in which they spend during downturns, but they also spend during upswings as well. And so the consequence of this reluctance to catastrophize on the part of forecasters is a failure to anticipate the ratcheting upward of the level of debt that comes with each successive shock to the public finances, which in the UK has seen debt climb from under 40% of GDP prior to the financial crisis in 2008 to almost 100% of GDP today. And finally, at the same time, a third and final shortcoming of the macroeconomic forecasting profession has been a focus on the level of debt as the principal measure of fiscal sustainability, to the exclusion of considerations around both its cost as well as its maturity, as well as other liabilities and assets that are relevant to the government's long-run fiscal position. And I think this is best highlighted by two facts, both of which come out of our EFO as well as the ONS's fiscal data. The first is that while the level of debt has more than doubled over the past decade as a share of GDP, the cost of servicing that debt, measured as a share of government revenue consumed by interest payments, has more than halved over the same period. And the second fact is that the UK public sector's total liabilities are actually more than 50% greater than its total stock of debt, once one takes account of non-debt liabilities, in particular in the form of unfunded public sector pensions. So with those as the challenges and problems we faced as economic forecasters and we've had to confront over the last decade, what are we as the government's official forecaster attempting to do to learn the lessons from the past, improve the way we do our jobs, and enable better fiscal planning and policy making? Well, let me highlight three things which we're going to be doing, which we have been doing over the last few years and we'll be doing more of in the coming years. The first is that we're taking a harder and deeper look at how we forecast the supply side of the economy. We've done this in the near term during the pandemic by building up a sector-by-sector picture of the level of economic output that was possible to produce in each month under the government's various public health restrictions. And we're also monitoring the longer-term legacy of the pandemic for the capital stock, labour supply and productivity, where there's currently a lively debate about the degree of permanent scarring that may result from the traumas the economy has experienced over the past year. A second thing we're trying to do, even more than previously, is to emphasize the degree of uncertainty about the economic and fiscal outlook, both in the near term, but also over the long term. And we started doing this by publishing fan charts around our central forecast about a decade ago. But the limitation of this approach was that the range was based on historic forecast errors, which failed to effectively communicate the radical uncertainty that's been created by the pandemic, which has been both uncertain in its severity, but also has been highlighted by various speakers in its duration. So in our November forecast, we constructed three alternative scenarios for the path of the virus, as well as the government's public health response, which even provided for the possibility of things like the failure of the government's test, trace and isolate system, as well as the emergence of new variants of the virus. And we've also begun publishing a biennial fiscal risks report, as you highlighted, Jagjit, which looks at a wider range of potential shocks that could affect the UK's economy and public finances. And the third edition of our fiscal risks report is due out this summer, and will be placing particular emphasis on three tail risks. First, the pandemic itself and the legacy that it leaves to public finances. Secondly, the economic and fiscal impact of climate change. And third, the risks associated with the government's elevated debt stock. And a third and final thing we're trying to do, together with our colleagues in the Treasury and the ONS, is to begin to forecast broader measures of the government's balance sheet, including public sector net worth, which capture a wider range of government assets and liabilities. And whether this forms a formal part of the government's fiscal framework or not, we think that providing more information about the evolution of the government's full range of assets and liabilities recognized in national accounts helps to improve the overall transparency of the public finances. And in particular, it helps to shine a light on how the government is managing its burgeoning portfolio of loans and equity investments in everything from affordable housing to satellite companies to high-tech toilets. And we'll be publishing a working paper about the methodology for constructing this forecast in later this year. And so with that as a summary of what we're trying to do as an official forecaster to make better fiscal policy in the coming years, I'll hand it back to you, Jagjit. I'm very happy to participate in the subsequent discussion.
Thank you, Richard. That's a very deep and complex agenda that you're pursuing, and there's a lot of good work there, I think, trying to understand what's currently going on in the economy. I suppose the question is, how do we ensure that you're capturing all the good work out there? Because there's a lot of work that's been going on internationally and nationally on thinking about supply side implications and how we ought to be moving ahead. So I think that there's an agenda there for a dialogue for us. And clearly what we've been unable to talk about, and I don't want to tie you to that, is just what is the government aiming for? What is the appropriate path for fiscal policy, given all the things that the economy is confronting? But I don't think we're going to answer that in the next minute or two. I think this purpose of today was to launch the report, give a platform for experts across the country and also in Basel to give us their contribution as to where we need to be going in a fiscal framework. I don't want to put words in anyone's mouth, but I think there's work to be done. And Richard is clear about the work that he has to do. The economy is in no way recovered from the COVID crisis, or indeed the other two supply side events that Richard mentioned as well, the global financial crisis. It's had long-lived effects on the economy, and we're still dealing with the traded shock from the exit of the European Union. So there is an enormous amount of work for macroeconomists to be thinking about, and where there are gaps, there is a role for fiscal policy. But at all times, we're thinking about a framework that has some notion of rules in it, but still strong elements of flexibility that will allow us to deal with shocks as they come along. But then our problem will be year after year, how to assess whether we're in the right space or not. So the normative part of our analysis is often still missing. What should be done, what should have been done, and what can now be done are the questions that we are not collectively answering, it seems to me. And often we don't know. It's clear to me, having sat in Dean Trent Street either exactly or virtually for the last 5 years, it's really hard. really hard to know what to do in real time. And that's where I think we're arguing for a more collective banging together of heads. Let's think about the alternatives in a more open and transparent manner, talk about where we are so those decisions become more accountable. Then over time, I think we will raise the quality of policy making. And I think that is our main message, because we don't know exactly what we should be aiming for, and we don't always know what to do. But if we can develop a framework that allows for more interaction over time, I think we'll arrive at a better place. So I want to thank you all so much for your contributions today. For those of you who were able to join us online, I think this event was recorded. For once, I managed to use no four-letter words, so I think we can put it online subsequently. That should be okay. And I really am touched by the time that everyone's given to contribute today, but also to the occasional paper. My colleagues at NIESR, Neil Lakeland, Chloe Ridyard, for putting the event on, as well as putting out our occasional paper, volume, book, report, whatever we want to call it. I think we'll be getting hard copies off to participants. And I would encourage you to read it and come back to us with comments. It's incredibly useful for us to have these dialogues with people. Thank you ever so much. One parting shot, if I might. Adrian has threatened to beat me up if I didn't mention this to those of you still on the line, is that have I shared my screen on Wednesday afternoon? We have our first parliamentary lecture on really on the labour market. And for those of you who are able to attend that, it's by John Cruddas, whose book is about to come out or has come out. In fact, I think I've ordered my copy. And if people want to join that, I'm sure we can send a link to everyone who signed up for this as well. So do stay part of the NIESR community and the kind of things we're working about. It seems to me the economy and the country needs our expert advice. Thank you all very much and see you soon. Bye.